Okay, welcome to the first lesson of our new unit on the Great Depression and the New Deal. Today we're going to talk about the stock market, and we're going to start by explaining what a stock is. When you invest in a stock, you are actually buying a tiny, tiny piece of a company. Stock is sold in units called shares. For example, Chipotle is divided into 30 million shares. These shares can be bought and sold by the public on the stock exchange. If you want to buy or sell stock, you have to do that through a person called a stockbroker. You can't just go directly to the company and buy stock. Fortunately, now there are apps and websites that are basically stockbrokers, so it makes it more affordable. The reason why companies offer stock shares is to raise money they need to grow their businesses. For example, Chipotle might want to raise money to build more stores. People buy stocks to make money. Mr. Krabs bought one share of Chipotle stock in 2016, hoping that the company would become bigger and more valuable. If that happens, then Mr. Krabs will be able to sell his stock for more than he paid for it. That's how you make money in the stock market. Buy low, sell high. But of course, there's no guarantee that the price of your stocks will rise. In 2017 and 2018, the value of Mr. Krabs' Chipotle stock actually dropped in response to some bad headlines about people getting sick from Chipotle food. This is because a lot of people lost confidence in Chipotle and sold their stock, driving the price down. Fortunately, Mr. Krabs decided not to sell when the price dropped. He held on to his stocks and waited for the price to rise again, which it did. So if Mr. Krabs bought his stock for $700 in 2016 and sold it in January of 2020 for $850, he would have made $150 in profit. That's how people make money in the stock market. In the long run, the price of most stocks gradually increases, as opposed to the value of cash, which slowly decreases. This is why people invest in stocks as part of their retirement plans. But in the short term, the stock market can be risky and unpredictable. In the last couple of weeks, Mr. Krabs' stocks have really taken a hit because of the coronavirus. By the end of this week, his Chipotle stock will probably be worth less than what he paid for it. Almost all of the stocks are down now because investors are expecting a big economic downturn. Last week was the worst week for the stock market since the 1929 crash that started the Great Depression.
The Roaring Twenties, a glittering decade, soon came to an end. But at that time, everyone thought the party would carry on. Wall Street, the pantheon of capitalism. Here, millions could be won and lost. Yet for 7 years already, no one had lost. The stock market at the top, at its end, out of reach.
And when the market kept going up and up, it drew all kinds of small investors into it. The man in the street, the barber, the school teacher, the postal worker.
Times had never been better. Who was rich became still richer. The poor, on the other hand, had the chance to become wealthy. The stock fever gears America up. New technology boosts the economy and the imagination. The stock exchange gain multiplies every single dollar.
They expected it to go on forever, just as they now expect the stock market to go on up forever.
In the summer of 1929, the overheated economy was going full steam ahead. More was being produced than could be sold. The first few bankruptcies appeared. Still, no one took these seriously. The Wall Street fever of paper share trading continued.
Investors simply weren't paying attention to the underlying economic trends that were taking place. And some might say that's when greed takes over from common sense.
That summer, Eva Adams' stock hints were very popular. It seemed she knew how each stock would change. Her profession, not a broker guru, but a fortune teller. The moment of truth came on Thursday in October 1929. On this day, America woke up and a nightmare began. Sold coupons completely covered the exchange floor.
People made offers to sell, and there was nobody there to make a bid to buy the stock. And that was when I would say panic set in.
There was no stopping the panic. Selling became the motto of all brokers.
Prices collapsed, just collapsed.
The collapse of the stock exchange had spread like wildfire in New York. Thousands of people streamed to Wall Street, fearing for their shares. Out! Out! Get out of here! Get out of the market before it collapses.
People were just calling up their brokers and say, sell at the market. And panic, of course, fed on itself and got worse and worse.
Not a dream, but a nightmare came true. On that terrible Friday, Wall Street went bankrupt. Some had lost everything they owned. In the weeks after the stock market crash, just in New York, a dozen bankers committed suicide.
I remember walking down the street in New York with my father after the crash, and we'd see fellows who used to be the bankers standing on the corner selling apples for a nickel a piece. That was pretty frightening.
The Wall Street crash was the beginning of a worldwide change, a new economic era, the consequences of which, in those days and weeks, no one could have guessed.
The Roaring '20s was often referred to as the Jazz Age. And after the crash in 1929, the music stopped. The great party was over.
But don't let this scare you away from investing in the stock market, especially if you're saving for a long-term goal, like buying a house or saving for retirement. If you're prepared to ride out the highs and lows, the risks are pretty low and your investment will grow over time. And you don't have to be rich or be an expert to start investing in the stock market. In fact, the most important advice you need can fit on an index card. Here's my first tip. Start early. Just like the coronavirus, the stock market grows exponentially. Over the last few decades, the stock market has grown about 10% a year. So imagine you invest just $100 from the first job that you get. In 30 years, that $100 would grow to $1,700. So when you invest early in life, your money has more time to work for you. Second piece of advice. Don't try to pick individual stocks. Even experts who pick stocks for a living rarely do better than the average return of the whole stock market, which is about 10%. Instead, experts recommend that you invest in something called an index fund, which is like a stock made up of a teeny tiny piece of every company in the stock market. This makes it easy and less risky to invest. You don't need to pay an expert because you can buy index funds on an app or a website. And by diversifying, that means spreading your money out over as many different companies as possible, you'll reduce the risk of investing in a company like Toys R Us that ends up going bankrupt. Third, when your stock prices drop, which they will do at some point, don't panic. Wait for them to rise again before you sell. In fact, when prices drop, that's actually a good time to buy more stock if you can afford it, because it's like the stock is on sale. In general, a good rule of thumb is not to react much to the day-to-day prices of your stocks when you're saving for a long-term goal like buying a house or retirement. Okay, that's it for my stock market presentation. Check the red folder in Schoology to see your next steps.